In this lecture, we're looking at refundable customer deposits. These fall into a category of liabilities that result from advance collections, situations where a company collects cash before it has fully earned it. Refundable deposits are similar to unearned revenue when a customer pays for a product or service in advance, only the expectation is different. While we usually expect to earn revenue for making a sale to a customer, under certain conditions, deposits actually have to be given back. A refundable deposit comes with a promise attached, a promise to give the money back if the customer adheres to certain agreements. And as long as that promise exists, the cash advance isn't really revenue. It's actually an obligation, a liability. Refundable deposits appear all over the economy. Utility companies often collect a service deposit from new customers, which they return when the account is closed in good standing. Companies that ship products in returnable containers, think kegs, gas cylinders, or pallets, collect a deposit that's refunded when the container comes back. And landlords and rental companies collect security deposits, which are returned at the end of the lease, less any amounts owed for damages. In each of these cases, the company is holding someone else's money with a promise to return it. That promise is what makes it a liability. The accounting for refundable deposit follows the obligation. When a company receives the deposit, they debit cash and credit a liability, something like refundable deposit or customer deposits. Although cash came in, the owners of the company cannot claim it. The claim to the new resource actually belongs to our customer. So we record a liability rather than increasing retained earnings by recording revenue. Then one of two things happens. If the company returns the deposit to the customer, they eliminate the liability with a debit and credit cash. The obligation is satisfied and it's off the books. But if the deposit is forfeited or the company has otherwise earned the right to keep it, then we move the claim to that new resource from the customer to the owner with a debit to the liability and a credit to revenue or some other appropriate income account. Only at that point does the deposit become income, because only then has the obligation gone away. Let's trace a deposit from start to finish. This company has shipped their product in $150,000 worth of expensive containers, and customers were charged twice that in the form of a refundable deposit. Looks like 90% of those containers were actually returned within the specified period of time. In this case, looks like a year, and 10% were not. Let's record the receipt of the cash from our customers, the return of the 90% of containers, and income for the 10% that never came back. Okay, you can see I've outlined here assets equals liabilities plus equity again, so we'll use our T accounts to track this transaction. And we know right off the bat that we've actually got an inventory account. And we know that because they used $150,000 worth of containers. So I'm going to put that $150,000 in this T account, knowing that those are the containers that we have given to our customers and expect to receive in return. So the first entry that we need to make is the refundable deposits that we've received. And they told us that they're charged a deposit equal to twice the cost. So the first entry is the deposits. I'll debit cash. And that's for $300,000 because twice the deposits or twice the cost of the refundable containers. And the credit would go to refundable deposits. So I also need over here under assets a cash account for the $300,000 received. And that new resource, that $300,000, can be claimed by the customers, which is represented by this liability account called refundable deposits in the amount of $300,000. The next entry that we need to make is to record the containers that were actually returned to us. And so 90% of the containers were returned. So we're going to debit the refundable deposits account. 90% of $300,000 is $270,000. So that is 90%. And we'll credit cash because we have to give the cash back to those customers in the amount of $270,000. So I'll debit this account up here and record the negative cash, the outflow. Finally, we're going to record the deposits that were actually forfeited by these customers and they never returned the container. And we have two parts to this entry because we get to record some revenue, but these containers weren't free. We also need to record the cost of them. So the first thing we're going to do is debit the refundable deposits for the remaining amount, which we've got $30,000 left in here. So $30,000 is going to be the debit to refundable deposits. And then we're also going to record revenue. So credit to sales revenue for $30,000, which means we need a revenue account over here. And remember, revenue is the credit side of retained earnings, so it's going to increase retained earnings. But we also need to record that we no longer have these containers. So we're going to debit cost of goods sold for the half of the cost of these containers that were never returned. So 15,000, that's half of that cost, or half of the sales. And we'll credit here the inventory account. We never got these containers back. We no longer have them. They become a cost of the revenue that we made. So I'll have cost of goods sold over here in the amount of $15,000. And we will decrease the asset inventory account by $15,000. So we still have some containers on hand, and we have recorded the income as well as all of the costs related to these containers. Here's what to remember. A refundable customer deposit is not revenue. Don't confuse the two. We record a liability when the deposit is received and clear the liability when the customer does whatever they agreed to do to get their money back. Only a forfeiture, based on time or a failure to hold up their end of the deal, moves the claim to the resource from the customer to the owner, converting the deposit into earned income instead of a liability.